Hello, everyone. This is not a fake. This is not a hoax. This is an actual video. Yes, it is not the podcast. It is an actual video. Welcome, one to Degenerate Dividends. So, I promised. I had a handful of people ask me just to do when are you coming back? When are you coming back? And then for the longest time, this has been going on since like early November. I've said I'm gonna do a video year end, just summarizing how the portfolio is doing and whatnot. So here I am. I committed to the promise. I know I quit YouTube and whatnot, but I am making a year end video. Maybe I'll do a once a month video just to show the portfolio, but I don't know how much is going to change, so I don't know how beneficial that would actually be. I know I made a video of why I quit YouTube, but if you want more details on why, the pretty much the real like backbone of why I did it, don't get me wrong, everything in that video was true, 100% true. But there was an underlying personal reason why I did it, and if you want to know, you can look at my Twitter, and there's an entire thread that I made. Essentially, I just like lost a best friend, and the whole thing was really, really shitty, and that pretty much led me on a tangent to hating every single person that I know. Anyway, if you're interested, you can look at Twitter, my Twitter down below, and you can read the thread if you're interested. But if you're not, who cares? Let's go on. So let's go into full screen here. The portfolio value is at $47,158. Maybe it's a little easier if I... no, it is not. That is very ugly. Okay, so $47,158 is what the portfolio is currently at. So it's doing just fine. I transferred from M1 Finance to E-Trade. If people are not aware of that, if you don't follow me on the social medias, I did do the transfer of M1 Finance to E-Trade. So the homepage is a hell of a lot different. And finally, after about a month and a half after transferring from M1 to E-Trade, I finally got the correct percentages and cost bases down. So my total unrealized gain is actually correct. So my capital appreciation for the whole time has been $1,873 or 4.1%. I must say, when you switch from M1 Finance to a normal brokerage, that money-weighted average return with the dividends coming in factored, oh my God, it makes your percentages way higher than they actually are. And the ego goes way up because if you factor in earned dividends from my portfolio, well, then that money-weighted average return on M1 would be closer to 20%. But just focusing in on the simple appreciation, it's at $1,800, which is pretty good considering I don't care about capital appreciation at all. Or do I? Because we're going to be discussing the portfolio and the significant changes I made. So if you just watch my videos and you haven't listened to my podcast or follow me on social media and all, my portfolio is going to look a hell of a lot different. So maybe now, let's use this so we can draw. So the top holding, and here is the value on this column. So I sorted it by value. So this is the highest portfolio values I have for each entity. So as you can see, the highest by far at $14,500 is PCI. This is PIMCO's Credit and Dynamic Income Fund. This is a closed-end fund. They just paid a special distribution, which was awesome. I'll get into that. I have 580 shares of this closed-end fund. As you can see, there's fractionals there. No, those fractionals did not transfer over from M1. These are dividend reinvestments, so I am dripping the entire portfolio. As you can see, a high dividend yield of 8.28%. So this is by far and large the largest position in my portfolio. PIMCO Credit and Dynamic Income Fund, 8.28% yield. So right now it is trading at about $25.25. And each share every month, this is a monthly dividend stock, is 17.4 cents per share. And what's awesome, so I am currently averaging, well, let's just get the calculator out. So I have 580.20 shares, and I know that it trades at 17 cents, 17.4 cents. So right now, if I were to never drip again, I would get $100.95 every single month from this. So I'm at a position where I really don't want to add any more to it unless it massively drops off, which I don't see in the near future. But right now, it is giving me a solid Benjamin every single month, and it's going to drip. So that 195 is going to just grow and grow. But $100 every single month. Thanks. This is why I love the monthly payers. It's just awesome that I have something giving me a Benjamin every single month. I really do not want to add to this position anymore. I want to let it drip. It's going to grow and grow because it is so fast and it's such a big position. I want to work on other positions. And let's talk about the other positions. So O, Realty Income Corp is the second highest. I haven't touched that in a long time. It's the yield, in my opinion, for owning a REIT is way too low for a starting yield of 3.75. I personally believe that if you're going to hold a real estate investment trust due to how bad taxes are, you better get at least 5%, or else to me, it's just not worth it. I mean, if you're going for total return, so capital appreciation and dividend payouts, then O is good because it is the capital appreciation on O has been fantastic. So if you're going for total return, then it is not a big deal to own Realty Income Corp. But in my opinion, if you're going for dividend yield, it is just not anywhere near worth it right now at 3.75% to own a REIT. There's plenty of qualified dividend payers, the normal quarterly blue chip stocks that pay over 3.75%. You'll get better tax treatment. So there's no reason to really add on to this position right now. I do have it drip. Right now, I believe it is slightly overvalued. So I wouldn't be touching this. Right now, it's trading at around $72. I would not touch it unless it reaches the low 60s pretty much. Or if the dividend yield gets anywhere close to 5%, that's when I would start buying again. $6,500. I have 90 shares of Realty Income Corp. The next one is going to be a huge shocker, especially if you listen to the podcast and say, you're being a little hypocritical with this purchase. Maybe, but let me talk about it. So this is Noble, and anyone in the dividend community is familiar with Noble, ticker symbol NOBL. This is Dividend Aristocrats ETF. It holds 40 plus holdings. All of them have been paying dividends for over 20 plus years. Why do I have Noble in my position? So, as many of my followers know, I do not own a Roth IRA. My wife just got a new job promotion and she got raised. And because of that, I am actually no longer eligible to even contribute to a Roth. So even if I did want to, yeah, I know I can do backdoor Roth IRA contributions. But because of income limits, and believe me, it's all her, not me, I can no longer contribute to a Roth. So I had to take a step back from my portfolio and just be realistic with myself. I'm being an idiot in terms of taxation because I'm just screwing myself with stuff like PCI and O and Maine. All of these get taxed at ordinary income levels. And if you follow me on social media, half my portfolio was bonds recently. So I actually sold all of the bonds and I went into Noble. So why did I do that? So the combination of my bonds were yielding around 2.1%. As you can see, Noble is yielding 2.45%. So I'm getting the same exact yield with less harsh taxation. Not only that, but I mean, the upside on Aristocrats is way higher than bonds. So I had the bonds for essentially downside protection. And the thinking was, okay, when the economy does take a dip, it's going to happen eventually. When it does take a dip, I sell off my bonds and then buy the other positions that I want. And then I realized, well, all I'm doing is missing out on a lot of gains. And yeah, I know a lot of it's capital appreciation gains, but those won't get taxed. And if this position does grow very large, I can just sell that for a higher position in the future. A higher yielding position in the future is what I meant to say. So ultimately, when I'm older and I'm ready to take some of the dividend income, I could just take this position. Hopefully it would grow a lot because it's getting those nice capital appreciation gains, nice total return gains, and then put it into a higher position that I can withdraw more money right away. So I was being really stupid with taxes, and a lot of people who follow me know that I'm really stupid with taxes. I really don't care that much with it, but at the same time, if you're giving me the same yield, well, then it's stupid of me not to switch it to something that has qualified dividends and is going to have way more capital appreciation upside that I can sell in the future. If you just hold bonds, assuming they're not treasury or municipal bonds, and even those yield horribly because those are tax-free, but any other corporate type bonds, corporate bond ETFs, junk bonds, whatever, those all get taxed at ordinary income. Nothing qualified about those in most cases. it makes no sense for me to hold those over something that yields the exact same, is qualified, and has a lot more upside. So that's why Noble has taken a large position in the portfolio. It's the third largest individual position. Main Street Capital, I've been holding this one for a long time, along with GLPI. GLPI and Main have been staples for a very long time. So nothing too surprising there. Main is at 5,500. I have 128 shares, and then GLPI is at 4,800 and at 113 shares there. GLPI just raised their dividend from 68 cents a quarter to 70 cents a quarter. I'll be very interested to see what their return of capital has been this year, because they have been raising the dividend. Their stock price has gone up way faster than I anticipated. I think the stock price is almost honestly correlating with what the dividend yield should be, around 6 to 7%. It was yielding around 7.5% for a while. I bought GLPI in the $35 to $36 range, and it is now trading at $42 for a REIT that has no business appreciating in price right now. That's pretty phenomenal. So I have decent returns on that in terms of capital appreciation, but I'm not in GLPI for capital appreciation. I'm in it for returns, yielding 6.56%. I have 113 shares, and I have 113. Whoa, can we work? 113.83. We multiply that by the current quarterly of 70 cents a share. So every quarter I get $79.68. We multiply that for. So for the year I get $318.72 in dividends from GLPI. I am dripping it, obviously. That's why there's fractionals. So it's going to go up and up. And they have been raising their dividends pretty consistently every single year. Not crazy amounts, but then again, it's already yielding north of 6 to 7%. So I have no issues with the pace that they're increasing the dividend, because I'm in it for the high starting yield. So the fact that they're raising it at all is pretty awesome. VYMI, this is Vanguard's high dividend ETF and Vanguard's international high dividend ETF. We're at 4,000 and 2,000 respectively. The international position trades a little bit higher. This is a position that I really want to increase. So obviously these are qualified dividend payments as well. And I want to get more international exposure in my portfolio. So VYMI is awesome because it is 100% non-US equity positions. So that is something I really want to gain more exposure to in the portfolio, VYMI. Right now, I only have 35.26 shares. Only $2,000 of the 47,000. So I dramatically need to bring this one up. This is one that I will be working on, even though it is trading a little bit expensive in my eyes, but I don't care. I want to boost this position. It's one of those situations where, yeah, it might be overvalued. At least you think it's overvalued, but the position needs to just grow in your portfolio, period. There's no excuses. So this is one that I'm going to build up. VYMI and Noble are ones that I'm really going to build up, and I'm honestly considering selling O. And I know that's heresy to a lot of dividend investors out there, but I don't know. I really need to make out a list of pros and cons and go over why I might sell it. Is the yield worth it for me right now? I could put half into something like GLPI and Main, and then half into Noble, which I believe are, for my personal goals, much better positions. We'll see. If something like that happens, I will make a podcast episode about it. We'll see. I might make a podcast on all the pros and cons of why I might do it, and I can get your opinion on that. But so we're at VYMI, and we're down to the final positions, UTG and VRP. VRP is just a preferred income portfolio. I have $1,000 for $39 shares. I think I'm just going to leave this one alone. I don't want to sell it yet. I don't want to add on to it. It has a nice 5%. It pays out monthly. It's just preferred income shares. I like having a little bit of exposure to that, but nothing too crazy. So I think $1,000 is worth it. And then UTT is a utilities closed-end fund, Reeves Utility and closed-end income fund, yielding a nice 5.84%. I have 48 shares. It's going to be dripping. That flag indicates that there's a dividend event happening soon. So either it's going ex-dividend or its dividend payable date is happening very soon. That's all that flag means next to the position. So UTG, I would ideally like to get to $2,000 in value for that. It might drip its way there. This one is very overpriced at the moment. Utilities in general, there's a couple of them that they've had issues and they've gone down. But for a majority's sake, utilities have skyrocketed this in 2019. Why? I'm not so sure. Is it a move into more defensive positions? Not sure, but utilities have spiked quite a bit. And what's funny is that REITs have taken a dip, yet GLPI and O for me have been stable and or growing. So my portfolio is kind of counterintuitive to the market right now. But now that I own Noble, I'll finally be getting some market gains exposure. And I'm a lot more happy with it being qualified. And I'm not going to get heavily taxed on that. So that is the portfolio right now. It's at $47,000. One thing that I do like about E-Trade is that they have this estimated income tool. So this is taking projected dividends based on what the payments are now for all of your positions and what you will earn. This is the year projection of 2,600. So obviously it's going to grow with reinvestment and whatnot and me putting more capital into the portfolio. But it's really cool that it automatically does it. I no longer have to keep a spreadsheet. I just have to follow my positions, make sure they're not cutting any dividends or whatnot. So if you want to talk in terms of the cash flow challenge, we have $2,601.60 coming in per year. We divide that by 12 and we get an average monthly payment of $216.80 per month. So after I sold off the yields and went into this, my monthly figure didn't move that much. So I'm happy to report it's at $216.80 per month on average in dividends. The quarters are obviously going to be way higher than the average a month, but I showed you PCI, so I'm guaranteed that $100, that nice Benjamin coming in every single month, along with what I got currently from O, Main, UTG, and VRP. So I think I get around 160, 170 range guaranteed every single month, assuming they don't cut dividends or anything. And then the rest is heavy on the quarters. So this past December was miraculous for me. I received like $600 to $700 in dividends. It was just awesome. So yeah, that's the portfolio. Hope you enjoyed this video. Maybe I'll make this once a month, or if anything changes, maybe I'll just do a video if anything like drastically changes in my portfolio. Other than that, I'll keep up the podcast episodes. I know some of you like it, some of you do not, but oh well, that's just how it is. I much prefer doing podcasts versus this stuff, but hope you enjoyed the video. Let me know your thoughts down below. See everyone in the next podcast episode.